at rupees 67 crores for Q2FY21 as against 46 crores for Q2FY20, up by 45%. PAT margin stood at 21.9%. Coming to the Q2 business-wise performance, again our high-value business grew by 42%, while the legacy was lower by about 13%. Specialty segment grew by 9% to 102 crores, while CRAMS segment reported a strong sales this quarter. It grew by 110% to 99 crores. The legacy business showed a downtrend due to fall off in the inorganic segment by about 6% to 49 crores, and in the ref gas 18% to 58 crores on a YOY basis. Our balance sheet remains strong. The net cash position as on September is about a little over 450 crores. Our prudent use of capital has helped us maintain our capital employed, the return on capital employed around a little over 30%. The net cash flow from operating activities stood at 98 crores compared to 40 crores last year, showcasing our operating efficiencies. I think that's all from my side, as we'll be okay to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sudarshan Padmanabhan from Sundaram Mutual Fund. Please go ahead.
Good morning, and thank you for taking my question. Sir, my question is on the CRAMS part of the business. It's reported a very strong growth for this quarter. Can you give some more clarity with respect to the utilization, on the CGMP3 plant, and specifically from your own expectations? I mean, we normally have internal expectations with respect to, the utilization for the first year, second year, and third year. So, are we running significantly higher than what we had envisaged in terms of utilization for the CGMP3 plant?
Yeah. So, good morning. So, in Q1 as well as Q2, for CGMP3, we saw capacity utilization of over 80%. Typically, as we have been saying, that for any multi-purpose kind of a facility, any capacity utilization over 70% is actually considered to be optimum. The reason why we had very high utilization in Q1 and Q2, as you are well aware, this is a business where our typical production cycle tends to be a little longer than our other businesses. And we had a lot of orders that had actually got bunched up, which we had announced in the commentary that we made in Q4 as well. So we had a lot of orders which basically led to this strong utilization in Q1, Q2. And also our team has actually done an excellent job of execution, wherein we didn't face as many problems in ramping up the production to CGMP3 level as was earlier expected. So a lot of the orders we actually got first time, which also helped us deliver most of the orders on time in this period. So to answer your question, our utilization was above 80%. It was slightly higher than what we had anticipated in the first year of operation.
And with respect to this bunching of orders, and you also made a commentary that we are seeing very strong inquiries. I mean, while I don't want to, discuss quarter on quarter, which might not necessarily be right, but from a business trajectory point of view, I mean, if I look at the last few quarters where, the lows has been at around 25-30 crores, and we had been running at around, say, anywhere between 50 crores or 45 to 55 crores. I mean, do you think that this run rate should substantially be higher given the visibility of the business and also the new capacities coming in. So here what I'm trying to understand is whether, are we, looking at least utilizing it, over what we had talked about, and probably looking at announcing another capex, given that we are running chock a block on this, CRAMS business.
Yeah, so there are 2 or 3 questions that you asked there. So let me take each of those separately. So if you look at the trajectory going forward, we are actually again seeing extremely strong tailwinds in this particular business, both from our existing customers as well as from some of the newer customers that we have been developing, both in Europe as well as US. From the run rate perspective, we had earlier mentioned that our focus was to get to a run rate of 50 crore every quarter. From now on, our focus would be to at least get to the run rate of what we have done in H1. So that is what we would actually look to do in 2 quarters, every 2 quarters. So we actually delivered about 133 crore of revenue in the first 2 quarters, which is H1, and that is what we will look to do going forward. There could be some quarters which will be slightly lower, some quarters which are slightly higher, but at least on a half-yearly basis, this is what we should be able to continue to do. While we are doing this, there are 2 things that we are really focused on at this point in time. One, a process optimization, by which we are looking to improve the norms, improve the yields, and also significantly reduce the batch cycle time, by which we will be able to free up the capacity available. Also, we have identified few areas for debottlenecking, which will require some minor capexes. By doing that, in the second half of this year, we will actually be able to bring in additional capacity just through this smaller debottlenecking projects. Once we complete that towards end of this financial year, that is FY21, is when we will be in a better position to understand what the order book looks like for FY22 and FY23 and take a call on the next capital investment in this particular business. So that is when I think we should be able to make a better commentary on CGMP4. Does that answer your question?
Yes, sir. That was pretty clear. Sir, one final question from my side, if I may. On the specialty chemicals, here again, this business, we are seeing good, inquiries, a growth happening both on agrochemicals and pharmaceutical side. And we have, over the last 2 to 3 quarters, consistently been saying that capacities are, running fairly high. So here, what is the, strategy? I mean, when are we looking to expand capacity? And I mean, are we looking to, I would assume that a lot of products would have also moved from the high volume, low profitable, low margin to anyway, highly profitable and low volume kind of product, which is reflecting in the margin. So from here, where do we go as far as the specialty chemicals is concerned?
Yeah, so let me give you, first of all, some brief background on short term, and then I'll give you on mid to long term. On short term, which is specifically related to Q2 and Q3, basically through end of the year, we continue to see pretty good momentum in our life science and crop science business. However, industrial business is a little softer as we get to the end of this year. We believe that again from starting off the next calendar year, because there the contracts actually run for calendar years, we should again start seeing a good momentum on the industrial side. And as you know, our business is divided 40-40-20 between pharma, agro, and industrial. So that's on the short term. Also on the short to mid term, we have actually done some smaller debottlenecking capexes in our existing site. A lot of those have got commissioned in Q2. Some of them are getting commissioned in Q3, but those are relatively smaller capexes just to get incremental capacity, bring incremental capacity into our business. We are currently working on number of new projects. These are both ones that will require standalone facility, and there are those that will require setting up of multi-purpose plant. A lot of these projects have completed the R&D hurdle. Some of them have already completed the piloting hurdle. Some of them are currently in piloting, and some of them are actually in the engineering. What that means is that in this financial year, we are expecting to at least have few of these get converted into specific business plan, which will be presented to the board and then will entail actual investment in Dahej. So we expect at least a few projects to be announced in this year, which will then give us capacity, significantly higher capacity from calendar year 2022 onwards.
Sure, sir. Thanks a lot. And sir, final remarks on the Piramal deal. I mean, any reasons why we have decided to part ways, and any kind of businesses that we might lose because of this potentially?
Yeah. So will we lose any business? The answer is no. What was the logic here? I mean, as you all know, what did this JV entail? This was basically manufacturing of one product for one customer, which is basically Piramal, which was going into the anesthetics market. The focus of Piramal was basically to grow the anesthetics market, for which they needed a product at a particular price. Whereas for us, the focus was to use this platform to do a lot of other things that we want to do in our specialty chemicals and HPP segments. So we felt that it's in best interest of Convergence, as well as best interest of Navin Fluorine, as well as Piramal, that we actually have a clear focus in what they wanted to do and what we wanted to do, and have 100% control over our own destiny. So they will continue to drive the anesthetics business that they want, the way they wanted to do, with 100% control, and we will drive the growth of this platform into newer segments, other segments which are primarily in HPP and specialty chemical, which is not focus area for Piramal, the way we want to do, and have 100% control over that. So the logic basically said that it is in best interest of all the three parties that we separate and chart our own growth trajectory. So having agreed on the logic, then we came to the table and said who should basically acquire this particular asset, who should be running it, etc. And we felt that Piramal was probably the best owner. They already had 51% in this particular business, and they were probably the best owner of that, given the fact that this product was only going to Piramal. This deal gives us a perpetual license to the technology platforms, which means that we will be able to use these platforms to develop and sell a lot of new products, which will get developed in the next few years for completely newer applications. So that is something which was of our interest, and we will continue to do that and have 100% control over it. So that was, in short, the logic behind this particular separation, and we'll continue to drive our own growth trajectory with 100% control.
Thanks a lot, Rajesh. I will join back with you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please restrict your questions to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Good morning and thanks for the opportunity. Couple of questions from my side. First, on the gross margin side, just wanted to get your qualitative view on interplay of product mix and gross margin. There is no visible trend there in terms of how the gross margin moves and how the product contribution are changing. Because last quarter, specialty chemical had a higher contribution and we did a much higher gross margin. And this quarter, CRAMS had a phenomenal sharp bounce back, and the gross margin actually dipped. We understood that CRAMS was more of a milligram to ton kind of a supply, and it was more of a research support we provide. Thus, the understanding was that it had a higher gross margin, but again, it could have compensated by higher investment into R&D and talent. Can you just give some qualitative understanding over there?
Yeah, Ketan, you want to take that?
Yeah, so while on the numbers, I'll just brief you about the gross margins. If you see our business segment-wise gross margins, I think on a quarter, this quarter and the last quarter on the high-value businesses of specialty and CRAMS, I think we've been able to maintain the gross margin levels. But as Rajesh spoke earlier in his speech, I think our legacy businesses have kind of pulled down our gross margin, especially more so in Q2 because of the pricing pressures that we face, both on the ref gas business as well as the inorganic business. On the ref gas, specifically on the export front, where we've seen the prices softening up. Again, lot to do with the lack of demand also, and the partly due to the Chinese impact on the global R22 prices. And also in the domestic market, the planned price which we were expecting to firm up during Q2 has actually not really happened, and we've had slight pricing pressure also on the domestic front. Similarly, on the inorganic business, with the end user industry not really opening up the way we had planned, and the domestic demand being under pressure, the prices were also quite subdued. Same was the story on the export side. I think the legacy business have played a key role in the second quarter, where we see the gross margins have slightly dipped over the Q1 margins. I think there's a difference of about a little over 2% between the gross margins. I think this change in the pricing structure has created an impact on the overall GP percentage.
Got it. No, I was just not looking for this quarter per se, but in general, how should we see when the CRAMS contribution increases? Because I think that's where we have a maximum capacity. Now that we are talking of a much higher run rate, once this pricing pressure on the legacy business becomes more normalized, the margin should inch up, right? That's how should we look at it, correct?
Yes, that's the exact way of looking at it.
Got it. Thanks. One question to Rajesh. On the backdrop that we spoke about debottlenecking, increasing the yield for the CRAMS and process improvement days, are we relooking at our guidance of 2.25x to 2.5x of asset turn in the CRAMS?
Yeah, I think it's a little too early to say that. But, I think because it's not only a question of or a function of these initiatives, but also a function of the kind of products that you do, kind of chemistries that you do, etc. So it's a little early to comment on that. But our focus has been and always continue to be to see how do we actually extract maximum sales from these assets. So our focus would obviously be to extend that from 2 to 2.5 to over 2.5. But what would that exactly be? It is a little too early to give a guidance on.
Got it. Thank you. Just one last bookkeeping question. What was our investment in the CCPL?
CCPL, our equity investment was about 34.3 crores.
Thank you. And best wishes for the coming quarters.
Thank you.
Thank you. The next question is from the line of Anand Bhavnani from Blend AIF. Please go ahead.
Thank you for the opportunity and congratulations for a strong set of numbers. Sir, on CCPL, I just wanted to double check. We will get a 7 crore rupee lease fee. So this would be for a certain number of years or for a single year? If you can elaborate.
No. This see the land that we have in Dahej is on a 19-year lease. That is how the lands are actually given to various companies by GIDC. When we did the CCPL deal, we have about 85-acre land. So when we did the deal, 11 acres were actually transferred or earmarked for the CCPL business. And now what we have done is we have just transferred that lease to the name of CCPL, which means now they will continue to have the lease for the remaining of 99 years.
Okay. So it's a one-time consideration of 7 crore that we got.
That's correct. Yeah. 7.9 crore.
Yeah. Sir, you also mentioned about the hexafluoro platform that we have access to post the CCL, divestment. Can you give us a sense of the opportunities on this particular platform over next, let's say, couple of years? How do you see, any products coming in? And would you be required to do capex in lieu of the fact that now the CCL facility is no longer accessible to you? Would you need additional capex? If yes, how much?
Yeah, so it is little early to talk about specific capex numbers, etc., because that will depend on the specific volume and the specific products. So here there are multiple hexafluoro products and then further derivatives of those. There are two kinds of applications that we have already identified. One is in pharma. The another one is basically in electric vehicles. So we are trying to understand how big these opportunities can really be. We are discussing with the customers on the specific products, which are derivatives of some of these products made through hexafluoro platform. And I think it will take us probably about 6 to 9 months to make that market assessment. And once we do that, we would have finalized the specific products. Then we will, get into either customer-specific agreement or we will get into doing those ourselves. But we are probably a year away from, giving out those specific details.
Sure. Thanks. Lastly, would there be a need for a joint venture in this chemistry, or at this point in time you have reasonable confidence of being able to do this hexafluoro on your own? And
so we have extremely strong confidence now to be able to handle the chemistry, to scale up the chemistry, and also to operate the plant at a commercial level. So we don't see for the technology piece a need to do any joint venture.
Thank you. I would request Mr. Bhavnani to rejoin the queue. Request participants to please limit your question to 2 at a time. Thank you. The next question is from the line of Hasmukh Gala from Finvest Advisors. Please go ahead.
Yeah. Hello, sir. Congratulations for really very good set of numbers. Also, looking for the legacy business, do you have any plans to get into any new molecules that will be in demand for next few years?
Yeah, so as I had indicated earlier as well, we are currently seeing a lot of new opportunities in number of our segments. So as far as our priority is concerned, we will focus on the specialty, CRAMS and HPP first. So that is where we have clear visibility in terms of what those opportunities going to look like. We clearly see a runway for those opportunities for many, many years to come. There is absolutely no regulatory headwind, etc. So we have a clear runway there. So those would be our priority. On refrigerant gas, we've actually seen some opportunities. There are a lot of regulatory issues there. So we are trying to understand what could the best case be and what could the worst case could be. So once we have more clarity, then we will actually take a call there. And on the inorganic, we've really not put any efforts or any management bandwidth to even understand what the opportunity landscape really looks like beyond just superficial understanding of that landscape. So as I mentioned, the priority would be specialty, CRAMS and HPP, and then refrigerant gases. And in inorganic, there is not much work that has happened.
The second question, as far as CRAMS are concerned, can you give us more color on the type of projects that we are doing? Let's say roughly these 130 crore revenue which we have, how much is coming from pharma, how much is coming from crop protection, etc. And on how many projects are we working at a time? If you can give some idea about the stages, etc.
Yeah, so this business, CRAMS business, is 100% pharma. So we only deal with American and European pharma companies to supply molecules into regulated markets, and these are innovative drugs. That means they are currently under patent. And these are molecules or these are drugs which are at very early stage of their development. So we typically start from the clinical stage, phase 1 stage, through phase 3, and then commercialization, etc. So these are typically molecules which are very early stage of their life cycle, and 100% pharma. We don't have any. There will be some small agro piece as a part of the CRO part, but that is there's no material impact on the numbers coming from the agro. Most of it is from coming from pharma. Now, if you look at the projects, projects is slightly different from the sales, because projects is what R&D and the technology team works on. So there, at any point in time, we have about 20 to 25 projects that we work on. These could be either from, because some of these projects are from single customer. So the customer can vary anywhere from, let's say, 10 to 15 customers. And specifically, if you look at the sales, we have always seen, irrespective of the number that we do in any quarter, typically about 65 to 70% of our sales is driven by the top 3 molecules that we do in that particular quarter, which is the same for H1 this year as well.
Okay. And so the last question is on your HPP project. Last time you had indicated that, as you go ahead and implement that project, a lot of new byproducts or things like that you will be able to make. And, independent of that particular agreement, on your own, you will be able to manufacture and market, etc. So then what will start from identifying those particular derivatives and, then go ahead beyond that particular contract which you have entered into?
Yeah, so currently that is not a focus, because the investment that will be required for that has already been made. So that has already been approved, and that the investment is currently going on. So currently our focus is on projects which require immediate investment, i.e. the specialty investments required in the hedge, etc. So that is our focus right now, and going to be focused at least for the next 6 months. Post that, we will probably start to look at, some of those molecules, etc. We have already identified some of those molecules. We have actually done some piloting in 2 of those molecules and supplied to some of our customers for qualification. So that is parallelly going on. But is there a concentrated activity going on in that particular area? The answer is no.
Thank you. I would request Mr. Gala to rejoin the queue. The next question is from the line of Karthikeyan from Yash Advisors. Please go ahead.
Yeah, hi, good morning to both of you. Wonderful performance. A couple of things. One is, can you talk about the contribution of Japanese customers to your specialty business? Yeah, sorry. So after you do that, yes.
The question that you were asking was contribution of Japanese customers, right?
Correct.
So if you look at our existing specialty business, the contribution of Japanese customers is relatively small. But if you look at some of the projects that we are working on, especially for a multi-purpose plant, there we have projects going on with Japanese customers. So we actually did some projects. We have been doing some projects for the last 3 to 4 years with some Japanese customers, but those were at a relatively smaller scale. But those relationships have now reached a stage where now they are looking for larger molecules or higher volumes of the same molecules from us, and hence they will be part of this MPP investment that we will be making.
Wonderful. Yeah. The second thing is a broader question in terms of automation of your facilities, both the existing ones in the CRAM specialty as well as the HPP. Can you take us through the automation levels at this point in time, the scope for further automation, and your broader thoughts on automation in general?
Yeah, so we are actually incorporating Industry 4.0 design factors in the engineering for our Dahej plant. So if you look at the project that we have currently going on, which especially related to HPP, that's a continuous plant. So relatively, it's easy to incorporate, the Industry 4.0 standards into the design aspect. And we are doing that. We have a separate company working with us only on the digitization and automation piece on that. Now we have just started working with them for our CGMP 3 as well, to basically automate a lot of operations, which is basically, I mentioned earlier with respect to process optimization. This is one element there. So some of the manual operations we are actually looking to convert to automated operations. That will not only help our batch cycle time, but significantly improve overall the control and the safety level.
Correct.
That would be the priority number 2. And then priority number 3 would be our existing facility in Surat, because as you know, Surat is a very old facility. So incorporating the digitization or the automation aspect into the Surat facility are not will entail significant investment. So what we have done there is the MPP that we have in Surat is what we have identified to incorporate some of these elements. So that's going to be our priority number 3. So we are working on each of those 3. And then we are also working more from the digitization point of view. We are also working at other aspects from the material packing, data security, data integrity, etc., which will not only impact our CRAMS business, but also the HPP business.
Thank you. I would request Mr. Karthikeyan to rejoin the queue. The next question is from the line of Rohit Nagaraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity and congrats on good set of numbers. So the first question is on the revenue generation from CCPL. So what kind of revenues were generating from there, and was it counted in the specialty chemicals, or now will it come separately?
So the CCPL, since it was a JV, it was just in the consolidation, the profit was getting added. It was not the revenues, etc., were not part of our account.
So incrementally, that particular revenue will come as a part of our specialty chemical segment. Is that right?
So what I am saying is, in the consolidated account, the numbers of CCPL were not added on a line-to-line basis. Only the profit percentage, 49% of the profit, was added to as a share of profit from the joint venture. So the revenues in our accounts did not include the JV revenue numbers.
That's what I'm saying. So the raw material that we are supplying, so now incrementally, once now the JV is off, will form part of our revenues.
The raw material which we were supplying to the CCPL was already part of our revenue. It was coming under our inorganic chloride business. Going forward, it will continue to come under our inorganic chloride business.
Oh, thanks for the clarification. And second thing, on the balance sheet, so we have higher inventories as well as the receivables are higher. So what is the reason for this? Thank you.
So inventory, which you see, we are at about, I think, around 58, 60 days, which we think are quite reasonable. And on the receivable side, given the high CRAMS sales that we had, most of it getting shipped out in the later half of the quarter, and most of it, a large chunk of it going out in September, I think has impacted the receivable numbers as on September end, but I do not think we have any issues on that front.
Thank you. Request Mr. Nagraj rejoin the queue. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah, hi Rajesh. As far as
hello, we can't hear you. Can you please speak up, please?
Yeah, hi Rajesh. Can you hear me now? Hello.
Sorry.
Mr.
I'm
Shah,
not
may I
able to
request
hear you at all.
Okay. Mr. Shah, may I request you to increase the volume on your phone, maybe?
Yeah. Is this better or?
All right. I could hear you. So, Mr.
Rajesh, can you hear me now?
Very, very faintly, but please go ahead.
Okay. Not really specific to this quarter, but basically the vision that we have charted out to become a more technologically sophisticated firm, grow and evolve in the areas of specialty and CRAMS and HPP. Not only focus on our traditional businesses, but let them evolve as they happen. And in the process, we not only evolve the chemistry strength, technological capability to work those chemistries to the better advantage, get bigger and superior projects, and scale the customers. So is this quarter a kind of a nice affirmation of that long-term journey, and the picture continues? That is the basic question I had.
No, I think that's a very good summary. And directionally, you will actually see us continue to emphasize these various elements that you talked about. In the high value added businesses, like you talked about, which is specialty, CRAMS and HPP, we have relatively good visibility in terms of what we want to do, both from the product perspective, chemistry perspective, and technology perspective, which will then obviously get translated into investments and the sales. As far as the inorganic business is concerned, there's not much work going on in a very concentrated manner there. And in refrigerant gases, we do have a very strong point of view as of today, but we see a lot of regulatory hurdles going forward. So we still, the point of view has not got translated into specific business plan, which we take to the board. But directionally, you're absolutely right. That's the direction that we will continue to take.
And which essentially means that the three focus areas are the ones where we shape and craft our destiny. As far as the other two are concerned, they are the existential kind of businesses, and our destiny will evolve. We really are not really doing anything much on what to do on that. And in the process, over a period of time, our margins and level of chemistry and its sophistication all will reflect that.
That's correct, yes.
Oh. Thank you, Rajesh.
Thank you.
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. I have one question and one clarification.
Can you please speak up? I think there is some problem from my side. There is a problem in my line. If you could please speak up, it will be good.
Sure. Am I audible now?
Yes, very much.
Okay, so sir, I had one question and one clarification. Taking the question first. Now, in the first half, we have seen, probably more than 350 basis point expansion in gross margin, which was driven by, Spec Chem in the first quarter and CRAMS now. And going ahead, given our focus on CRAMS, Spec Chem as well as the HPP business, and reducing contribution from the legacy ones, do you believe that these margins will sustain going ahead as well? Even if, let's say, the legacy business will bounce back in FY22, this margin expansion should sustain?
You're talking about EBITDA margin, not gross margin, right?
On the EBITDA and gross, both ways, whichever way you look at it.
Yeah, on the EBITDA margin, if you actually look at, so rather than looking at Q2 separately, if you look at H1 together, as we have indicated earlier as well, as we continue to scale specialty and CRAMS, and obviously HPP comes in from FY22 onwards, that will clearly have better impact on the margin. The margins will start moving up. The legacy businesses on the EBITDA margin side clearly have, they drag our EBITDA margin, operating margins down. This particular period, which is H1, if you see, our legacy business were significantly down. So what really helped our margin was not only the fact that our CRAMS businesses like CRAMS and specialty were up, but also the lower operating margin businesses like refrigerant gas and inorganic businesses were down. Now, clearly, we did not reduce the sales of those businesses to increase the margin, but that is just the way it happened. We expect going forward that our inorganic fluorochemical business and to a certain extent ref gas business will actually move up, and hence the margins might slightly go back to about 25-26% level. But as we move ahead, as was mentioned by the earlier questionnaire, as was mentioned in the earlier question, as we continue to scale our CRAMS and specialty business and as HPP kicks in, you will start seeing quarter on quarter and period after period EBITDA margin of what we have delivered in H1 or even better.
Sure, sir. That helps. And one clarification on the specialty chemical side. If I got you right in your earlier comments, you did mention, some of the debottlenecking led exercise, which will add to the overall capacity and hence the overall growth. Will it be fair to say that, this debottlenecking exercise will be able to, help us post a double-digit growth this year, and then the incremental capex will come in to drive the growth FY22 onwards? The reason I'm asking this is, even if you put in new capex, there will be some time lag as well, right? By when this capacity will come in, which is we're slightly curious in terms of, the timeline for the capex and the impact, incremental impact on our revenues accordingly.
Yeah, so we believe that if you look at the specialty business this year, will grow by and large to a similar extent as what we did last year. But next year could probably be slightly muted because the capacity debottlenecking that I talked about were relatively smaller debottlenecking exercises. They were relatively very small capexes because, our Surat facility, we are not allowed to construct any new plant or anything. So whatever changes we have to make in an existing plant. But from year 2022, you will actually see a significant increase in our business turnover, etc., which is when the new capexes that we are talking about now will actually start reflecting in the numbers.
Okay, fair enough. That's helpful. Thank you a lot, sir, and all the best.
Thank you. We would now request the participants to please limit your question to one at a time. The next question is from the line of Niket Shah from Motilal Oswal AMC. Please go ahead.
Hi, congratulations on a good set of numbers and thanks for the opportunity. Just wanted to know what is the cash on balance sheet, and just a similar question to that was, will Navin Fluorine be open to taking debt on balance sheet given the significant tailwind that the country is seeing now from China Plus One strategy, and obviously Navin will clearly a big beneficiary. Will we take a aggressive stance of taking debt on balance sheet? Are we open to that idea, or you would like to have a debt-free balance sheet? So that's the first question.
Currently, if you see the balance sheet in September, we have cash and bank balance of about 360 crores, and we add in the current investments in that, then the overall balance is a little around 460 crores on the balance. And regards to your second point, I think we've clarified earlier also that it's not that we have considered not taking any debt on the balance sheet. We are open to that idea, and I think that's the call we take as and when the capex that certain investments, given the current state of the balance sheet, can be funded in-house, then we would like to get it done through our current balances and the current investments that we have. But overall, we are open to taking debt, and I think probably towards the end of this year and early next year, when we have the entire project expansion plan on the table for specialty chemicals and anything coming up in CRAMS, etc., I think that's the time we'll take a more considered call on taking on debt on the balance sheet.
10-15 will not include the 65 crores is additional which will come up.
Sorry, I didn't quite.
The 65 crore which we have got from the JV, that will add up to this 415 for going forward.
Right. That's right.
Well, add up, right? Okay. And the second question was.
I'm sorry to interrupt you, Mr. Shah. I request you to rejoin the queue. The next question is from the line of Amar Murray from Alpha Accurate Advisors. Please go ahead.
Yeah, thanks a lot for the opportunity. Ramesh, my question is more from the project identification strategy perspective. Any changes we will look now post the travel and the Honeywell event, maybe more cautious in terms of looking the new opportunities, the new projects?
Mr. More, I'm sorry, but your voice is not clear, sir, so we did not hear your question very well.
Is it clear now?
Now this is better. This is better. Can you please repeat your question?
So I'm saying from the project identification perspective, any changes we'll be looking to do post the Piramal and the Honeywell event? Hello?
Ladies and gentlemen, we lost the line of the management. Request you to please stay connected while we check. Mr. Welling, can you please confirm?
Yeah, I'm here. Are you able to hear me?
Okay, great. We can hear you now, sir.
Yeah, can I go ahead and answer the question?
Yes, sir. Please go ahead. Thank you.
Yeah. So as far as the project selection criteria are concerned, there is absolutely no change in terms of those criteria. The criteria continues to remain the same. First of all, there has to be a clear strategic fit in terms of what we are doing. These opportunities that we look at, they need to be clearly profitable, sustainable. The profitability of those attached to those projects need to be clearly sustainable profitability. And then it has to meet our criteria in terms of the financial ratios, etc. So there has been no change post any of the events.
Okay. But then, okay. Perfect.
Thank you. The next question is from the line of Kashyap Javeri from MK Investment Managers. Please go ahead.
Yes. Sir, am I audible?
Yes.
Yeah. Thank you very much for the opportunity and congratulations for a great set of numbers. All my questions have been answered. Just want to, comment on one thing. The slide 1 of your presentation, probably now, reflects our strategy, very crystal clear, which is to value from partnerships. Just one question related to that. What are the risks that you see associated with, this strategy? Would the concentration, client concentration be a risk over here? We have seen in, one of the other, specialty chemical company, a cancellation of an order and, consequent, reflection on the numbers. So what are the risks that you see associated with the, with this strategy?
No, so for us, the selection of what we call partners is extremely critical. And when we use terms like partnerships, etc., we actually tend to use these terms very seriously. We don't, tend to use these words very casually. So these relationships that we have, commercial relationships that we have to cross a certain threshold to be called as partnerships. And those could be with customers, those could be with suppliers, could be with peers, etc. And the way we have planned our overall business framework, which is around 3 Ps, which is products, platforms, and partnerships, we are ensuring that on none of these 3, there is over concentration on a few products or a few platforms or a few partnerships. So we have the right level of risk mitigation playing out there.
Right. Sir, that's it from my side. Thank you so much, sir.
Thank you. The next question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Yeah. Hello, sir. So one question. So any new development in the fluorine chemistry space in terms of application, new products, deeper application of the existing category, which you would like to highlight?
Yeah, so it will be difficult for us to highlight those because a lot of that information is extremely confidential. Some of those we are independently developing in India or in UK, and some of those we are developing along with the customers, and hence those are covered by the confidentiality agreement that we have signed with those specific customers. But I can say one thing. If you look at any of the new application areas, so, just to give you some examples, you talk about 3D printing, or you look at electric vehicles, or you look at, the battery chemicals. You look at any of the newer 5G, any of these applications, fluorine plays a big and important role in each of those. And we are exploring opportunities in each of those sectors. Will those get converted into sales next year? The chances are lower. But what we are looking to understand is in which of these opportunities could there be an opportunity for us. So those 1 or 2 or 3 opportunities which we could significantly scale up the way we have done in case of the HPP project, which has already been announced. But there are a number of those. We are currently evaluating those. Some of those we are discussing with the customers, etc. But a lot of those are a little confidential to actually mention on a call like this.
And this is first time it's because it's a new technology, so no one in the world has made already. So it's the first time you are working, right, on it?
So this is the first time we are working on it. And we don't, in our understanding, there is nobody from the Eastern Hemisphere who has worked on it. But there are a few companies in US who have also worked on this.
Got it.
Or not worked on it, but are working on this.
Right, because it's a new application altogether, 5G or 3D or battery.
Yes.
Got it. Great, sir. Thank you.
Thank you. The next question is from the line of Vinay Jai Singh from Enam Asset Management. Please go ahead.
Thank you so much for the opportunity. Again, a big congrats for the results, and even a bigger congrats to get Ashok Sinha into your team. I've worked with him historically. Wonderful, thought person. So big congrats on that. My question, sir, is I think what everyone has been asking you on the capex front. We have a huge net cash position, 4.1 billion going to 4.7 billion with the cash inflow from the Piramal Group. Our EBITDA is growing this year, but our utilization rate in some parts are 80%. It takes, 1 to 1.5 years for capex to come in and then the growth to come. So growth is visible in F23. But, I'm just using your words, F22 could be slightly muted on the growth front. What do we do so that, we build capacity now that we know our products are right, our direction is right, as you put it, your partnerships are getting in place, but you're going slow on, getting a partner because you want to be there for the longer term. What is one thing, you guys would do to increase your capex on the ground just so that, your utilization rate remains at 60, 65 or whatever so that, you can have a huge growth, a multi-year huge growth story, and not a few months of hiccup and then again the growth coming back. Thank you so much.
Yeah, sure. I think it's a good question. I think the way we look at it is that, ultimately we have limited bandwidth. I'm talking about senior leadership bandwidth. Whatever we do has to be done very well. So if you look at the project that we earlier announced, so that initially took a lot of our bandwidth to ensure that that project actually came on track. In an ideal world, we probably should have announced some of the expansion plans already this year. But because of COVID, a lot of our mind space got shifted from growth to maintenance. So we had to make sure that we again bring our attention back to the execution of the existing business to ensure that we deliver a relatively good H1, and which is what has happened. Now that has happened, and parallelly we have been working on a lot of these projects through R&D, through piloting, etc. And you mentioned about Mr. Ashok Sinha. Similarly, if you see a lot of our other board members, etc., they expect a certain level of rigor to be applied to any project that is taken to the board. So that, the sustainability, the profitability of those projects, etc., are assured. So we want to make sure that before we take anything, we have the right level of assurance. Of course, there could be a year in between where, the growth could be muted. But, just to make sure or just to speed up the process, we will not present any plan which is shoddy or which is not very well thought out, because we clearly understand that we are not in this business to manage this business for a year or two, but we are here for the next 10 years, 20 years to make sure that we put this company on the right growth path. and we will continue to do that. And you will see that reflected in the decisions that we make in terms of capital investments.
Sure, sir. Thank you so much.
Thank you. Ladies and gentlemen, due to time constraints, we'll take one last question, which is from the line of Ranjit Tirumala from BNK Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congratulations on a great set of numbers. Actually, I had a couple of questions. The first on the exofluorochemistry which you have talked about. I was under the belief that Piramal had approached us since we had the specialization in fluorine chemistry and would have helped them to build the capacity. So just wanted to get some clarity that in the last couple of years, what was that particular technology that we had a value addition to ourselves. So the way it was perceived that we would be providing some value addition to Piramal. That would be the first question. And the second question, quarter by quarter, we are only seeing your commentary getting a bit aggressive or bullish on the capex front. So the way I understand right now, till last quarter, we were only expecting the capex on the spec chem side. Now with the Piramal JV, we are again indicating some bit of capex on the specialty chemical. So the clarification whether these two things are different or these two things were the same one. Thank you, sir.
Yeah, so on the second part, as I mentioned earlier, we have a clear growth plan, and that growth plan or trajectory or the pace is not going to change because of the Piramal transaction that we just did. It will just further reinforce, and we will be able to do that in a much better way because we have freed up some management bandwidth from the activities which could have otherwise contributed only incrementally to Navin Fluorine performance. So that's on the capex side. So that we will continue our business as usual. On the first part, on the hexafluoro, you are absolutely right. Piramal approached us because of our expertise in fluorination. And that technology, from the chemistry point of view, was the earlier version of that chemistry was actually developed by us. Then that chemistry was then further worked upon or perfected by both of us working together. And then CCPL worked on it to make sure that the scale-up happens successfully. And as you know, in a lot of our businesses, it's not about the process development because we are not really necessarily doing any fundamental R&D. A lot of these process development information is available in the public domain. It's the question of how well we repeat those in our lab, how well we optimize those chemistries, and the critical piece is how well we scale it up and we stabilize the particular technology, which is what the initial part was done by Navin Fluorine. Then the middle part was done together by Piramal and Navin Fluorine, and the later part was actually done by the CCPL team. And by getting these perpetual license, we will get access to all the three. We will actually have equal right to getting access to all the three.
Yeah, thank you, sir. Just one clarification. On the capex front, the capex which you have talked about from the CCPL stand is in addition to the capex which you were earlier guiding for on the spec chem side.
No, we have not guided any capex on the CCPL side.
Yes. So this is in the commentary in one of the questions you did indicate that hexafluorochemistry, you would be evaluating certain opportunities and there would be more clarity by the end of this year.
That's correct. So I mentioned that it will take us a year to really gain more clarity around what does that platform mean for us, what are the products that it will get translated into, and what kind of volume those products will have potential for. Which means that any discussion on capex, meaningful discussion on capex, we will be able to have only after a year. That's what I meant. So at least for next year, in terms of specific capex plans, our focus is very clear. It's primarily going to be led by specialty. Then there could be certain events in CRAMS, etc., which could actually bring some other opportunities to the table.
Yes, thank you very much for the clarification, sir, and wish you all the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Rajesh Welling for closing comments.
Thank you. So we believe our company will benefit from the strong tailwinds in the coming years. We are very confident to navigate through these tough times and emerge much stronger and leaner. Over the years, we have successfully transformed our business from volume-driven to margin-focused. We will continue to grow by leveraging our product basket and expanding our global network further, and we aim to scale up the business from the current level. I would like to thank everyone for joining on the call. I hope we have been able to respond to your queries adequately. For any further information, request you to get in touch with SGA, our investor relations advisors. Please take care, stay safe, and enjoy the festivals in the coming months. Thank you very much.
Thank you. On behalf of Navin Fluorine International, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.